All right, everybody, welcome back to another episode of Everything Business, right? I see that a lot of you are subscribing, and I want to thank you for that, right? Continue to subscribe and share with your friends, right? And yeah, so share with your friends, man, and let's try to get this subscriber base to the next 100, right? So we are 15,200 and something. Let's try to get it to 15,300. All right, so that's the next target. All right, remember to click a like, leave a comment. So let's get right into what control accounts is. All right. Now, these are some topics that will be helpful if you want to do well at control accounts. So you need to understand double entry principles, right? Debit, credit, so forth and so on. That is very important. So if you don't understand double entry principles, then you need to check out my other video. It will be in the footnote, right? It will be in the description and also at the end of the video, right? So check that out. You need to also understand balancing off principles, right? Balancing off accounts principles. That will come in helpful in this topic. And also cash book concepts. Very important. You understand cash book concepts. All right. Now, why are control accounts necessary? What are they? So control accounts are really just accounts that check for errors in the sales ledger and the purchases ledger. That's really what they do, right? Nothing more, nothing less, right? They are important because they make sure that you locate errors quickly, right? You know that in accounting, we don't want to make errors, and so you have some check-in system. Control account is one of those check-in systems that check for errors in the purchases and the sales ledger. Now we have two types of control accounts. We have the sales ledger control account, right? It is also called the debtors control account, and these days it is called the accounts receivables control account, right? Then we have the purchases ledger control, which is also called the creditors control, and the accounts payable control. So you have to look out for those names in the exam, right? Look out for those names because those names can always be used interchangeably. Now, you're looking at the format for the sales ledger control account, and this is as difficult as the sales ledger control account can get, right? There is one slight thing that you need to understand, or the theory behind the sales ledger control. The sales ledger control would be related to your debtors, right? Remember that debtors are persons who owe you money, right? And so one key concept for you to understand about the sales ledger control is that whatever it is that will increase the amount that debtors owe you, you will debit. So if you look on the debit side here, you will see like sales, right, and so forth, refund, this annual check, and I'm going to talk about them in a little while. On the credit side, you would find all the items that would reduce what your debtors owe to you, right? So that is very important concept. Write that down, pause the video, write it down, right? So now, if you look, you would realize that I have two opening balances in my sales ledger control. One highlighted in green, one highlighted in red. Now, the one that is highlighted in green, it is the norm because the sales ledger control account normally carries a debit balance. Debtors account carry a debit balance because debtors is a current asset, and asset account carries debit balances, right? So it normally carries a debit balance, which means that the balance brought down is normally on the debit side, and the balance carried down is always on the credit side. Well, not always, most times it's there. All right. Now you will realize that I have the balance brought down also on the credit side, and it is highlighted in red, and the balance carried down on the debit side, and it is also highlighted in red. Now, why do we have this? Now, it is important for you to understand that there may be times when you, as a business owner, may owe your debtor money, right? Because you may be in business together. You get what I'm saying? Right? So they may provide a service that you have to use, just like how they are using a service that you are providing. and they owe you, and similarly, there may be times when you owe them just the same. And when that happens, that is the result where you have a credit opening balance in the sales ledger control. All right. So that is the reason behind it. All right. So there may be times when you owe your debtors money. That's the basic reason. Now, if you look on the debit side, these are items that will increase the amount that debtors owe to you. Obviously, credit sales would be there because if your debtors buy goods from you, or if you sell goods to your debtors on credit, then it means that they are owing you more money. That is just simple. Now, these other two items are not so simple to explain: refund and dishonored check. Now, refund, you know what refund is? You're paying back your customer, right, for money that they would have paid you. Now, let's look at it. If your customer pays you money, pays you money, right? They pay you some money. You would have made a credit entry, right, in their account to show that the amount that they owe you is reduced. Now, if you are going to give them back, or if they pay you too much and you have to give them back some money, right, you would now have to do the opposite of making a credit entry, right? So you would have to make a debit entry to show that that reversal of the, or reduction of the money that they would have paid to you, right? So that is the reason why the refund is on the debit side. Now, if you look at the dishonored check, now dishonored check is really when a check bounce. We call it here in Jamaica when a check is bounce, or the check cannot be encashed, right? Now, when a customer pays you a check, right, it is similar to the refund. You would have made a credit entry, right, to show that there is a reduction in the amount that they owe you, right? You would have made a credit entry in their account. However, if the check is dishonored and it cannot be encashed, right, then you would have to reverse that transaction, and so you would have to do the opposite of credit, which is debit, and that is how the dishonored check ends up on the debit side. I already explained why the balance carried on would have been on the debit side, right? And it's the same thing if it occurs in a case where you owe your debtors money. Now, on the credit side, these are all the items that reduces what your debtors owe you. Obviously, if they pay you, whether in check or cash, you will put it there. Discount allowed, right? This is when you give a discount and it's an expense to the business. Returns inward, they are sending back goods to you, right? You look at this transaction here, this item, set off, right? Some textbooks will call it contra entry. Now, a set off is a type of contra entry, and what that means is that it is in both sales ledger control and the purchases ledger control on the opposite side, right? Now, the set off exists in cases where you and your debtor are in business together, where you are utilizing services of your debtor, as well as your debtor is utilizing services that you are providing, right? And both of you owe each other, just like with the balance brought down that I was explaining earlier. Both of you owe each other money, but instead of you guys just paying each other, right, you set off the amount that you owe to your debtor, and your debtor set off the amount that they owe to you, right? So you just, it basically what we call squits out, right? So that is really what set off is. It's a contra entry, so it is going to also be in the purchases ledger control on the debit side. Then I have bad debt. Bad debt is when your debtor is unable to pay you. It's an expense to the business, and it does reduce the amount that the debtor owe you, and you have the balance carried down. The thing about the control account is that the control account must be balanced. If the control account is not balanced, then it means that there was an error somewhere in the ledgers, and that is how we pick up the errors in the ledger. All right. So we're moving on. The purchases ledger account, purchases ledger doesn't control doesn't it is not as complex as the sales ledger control, because it doesn't have so many items like the sales ledger control, right? So the same principle would apply. The purchases ledger control is a liabilities account or a creditors account, which means that it carries a credit balance, right? So the balance brought down would be normally on the credit side, and the balance carried down would be normally on the debit side, as indicated by the green highlights. The red highlights are the opposite, and it's the same reason. Maybe your creditors owe you money, and so that is why you'll have a debit balance brought down and a credit balance carried down. On the credit side, you have anything that increases amount that you owe to your creditors, And on the debit side, you have all the items that decreases what you owe to your creditor. All right. So you have the bank or cash item there. It would reduce the amount that you owe to your creditors. Discount receive will reduce the amount that you owe to your creditors. Returns outwards, right? Or purchases returns. They have a set off, as I was talking about earlier. And on the credit side, obviously, you have credit purchases, which will increase the amount that you owe to your creditors. So that's basically it for your ledger, both ledgers. You just need to practice, right? And you're going to see me in my next video. We're going to be practicing, right? So click on the link for the next video. See you over there in that video.